Covered calls are one of the safest option selling strategies there are because you have 100 shares of stock, you're renting them out at a higher price. That's what selling the call does. You're obligated to sell the stock higher. But what if the stock takes off? Look at the stock right here of Google. At 2025, this stock has gone from $160 all the way to $300. If you sold covered calls on Google, you probably would have gotten called away right here around this red circle of 200. That's where the previous resistance was. Surely Google's going to stop going up. So you got called away at 200 and now you're looking at Google, it's at $326 and you're going, I have lost out on $126 of share appreciation. And you know what? That really sucks as an option seller. You're like, man, is it ever going to come back down? What is a great alternative to just selling calls? You could sell spreads. You learn how to sell spreads, you unravel them, and you can make some additional capital. Now, you're still going to eventually get capped out to the upside if a stock takes off like Google does, but you can make extra money by selling spreads versus just selling a covered call. Let me show you a quick example in Google of how we could make money. We'll unravel it only if we get tested. And what does unraveling mean? It's not as complicated as it sounds. Right now, Google is trading at $326. I would like to sell a covered call. If you have taken my covered call mini course, the series is right here in the comments below. My YouTube series on covered calls, you're gonna know I look out 30 DTE, I'm selling the 20 or 30 Delta call, and I'm looking to get out for a 50% GTC, good to cancel order. This is all simple math-based strategies. Nothing new there. But what a lot of math-based traders don't know is that they could sell a spread. You're going to collect less income, but if a stock takes off like this, you're going to have some protection that's going to let you stay into this. Let's hop over to Tasty Trade. Let's look at the options chain. Right now, February is about 39 DTE. So that means it's going to expire in 39 days. The 20 Delta is 365. What does that look like on the chart? 365 is pretty far away. As high as Google's been going, it'll be there in about 30 days, which is what we're selling. If you sold that call, you're going to collect about $425. Now, keep in mind, the market is closed right now. You're going to get about $425. That means you're basically selling your shares like $369, right? You take the premium plus the strike price. Not a bad win. Now, what would happen if you were to sell a spread here? If you sold at exactly the same level, you're only going to collect 75 cents. Let's talk about the mechanics of what this spread does. When you sell a call, you are obligated to give up your shares if Google closes above 365. That's what selling a call does. You have 100 shares. It obligates you to sell those 100 shares at 365. What does buying a call do? It enables you to buy those 100 shares that you just got called away on at $5 higher. Now, what happens if Google closes at 367 in between these two strikes? You're still obligated to let go of your share and you can buy your shares at 370, but why do you want to buy your shares at 370 if Google's at 367? You don't. So this long call is going to expire worthless. That's why you have to be a little bit more aggressive on selling a spread versus just selling a covered call by itself. If it's me, I start looking for the expected range and I say, hey, I really don't mind if this entire spread goes in the money, meaning let's just say that Google goes to $370 and I've sold the 355 covered call. I bought the 360. Saying, hey, I understand I have to sell my shares of Google at 355, but I'm going to buy them back at 360. We want it to go in the money enough to where we can take this call that we bought for like $5. If this goes in the money, the extrinsic part of this is going to make the option not quite worth $15, but this $5 call is going to be worth at least $8 or $9. So that's $300 in profit. And what I would do is I unravel it. So I'm going to sell the call I bought. Let's just say I make $400. That's conservative. You might make $500 on that call. I'm still obligated to sell my shares of Google at 355. That's what that cover call does. But you can roll this out in time. Now, remember, when you roll things out in time, you're going to get a credit. So looking at this example here, February to March, let's just say we had the 355. The same call is worth $10. That means I'm going to get a $4 credit to roll this out in time. Now that's a rough estimate. We're just gonna say I get a $4 credit to roll it out another 30 days. But I made a credit of $4 or $5 when I unraveled that long call. So I would take the credit from the long call that we sold and the credit that we get from rolling our shares, and I can move my covered call from 355 to 360. I can almost go up $1,000 in share and still get a credit. So I moved from the 355 to the 365 covered call by selling a spread versus just selling a naked covered call. This is something I like to do all of the time on stocks where I don't really want to get called away immediately. I think there still is some momentum in the stock and I want to keep going. This is something that I trade all the time in Mr. Money Maxwell. The Inner Circle, they have access to all of my trades. They get to see this in real time. If you are more interested, you should check out the link in my profile. Head on over to mrmoneymaxwell.com. Let me know, what do you think about selling spreads versus just selling covered calls?